Global markets move on risk appetite and regulatory signals, and today India's financial capital takes a definitive step that could reshape commodity trading. The IFSCA board has cleared a global commodity trading platform at Gift City, a move that aims to centralize pricing, clearing, and custody in a single fintech-friendly zone. For traders, this is a signal that infrastructure is catching up with ambition. For producers and consumers, it promises more transparent price formation and less friction across time zones. As supply chains tighten and volatility persists, the platform could compress transaction costs and invite new players, from banks to boutique brokers. The platform at Gift City is designed to host physical commodity futures and spot trading alongside clearing houses, risk management, and digital settlement rails. In practice, this means a regulated, close-to-metropolis-style hub inside Gujarat International Finance Tech City, where traders from different continents can access Indian benchmarks while aligning with international contracts. The platform aims to consolidate price discovery, trade execution, and post-trade verification under one governance roof. Think of it as a modern stock exchange, but for commodities like crude oil, metallurgical coke, wheat, and rare earth concentrates, with standardized contracts and real-time collateral management. Since India opened its financial center to global markets, regulators have sought better settlement rails and price transparency. Gift City has been pitched as a sandbox for cross-border finance, while the IFSCA was created to unify oversight for financial institutions operating inside the state. The push to formalize a global commodity platform follows decades of trading in Bombay and international hedges in Singapore, Dubai, and London. Similar ambitions have emerged with other exchanges in Asia, including Hang Seng's commodities segment and Shanghai Clearing. The project integrates India's growing commodity supply chains with evolving digital infrastructure, aiming to reduce opacity and latency for end users. Traders are watching the IFSCA decision closely as global risk gauges shift. Early commentary suggests deferred price risk could drop as traders gain access to Indian benchmark curves, sparking more hedging activity. Exchanges like NSE and MCX are already integrated with global banks, seeking to quote in a common platform, reducing basis risk between regions. If the platform attracts foreign brokerages, liquidity could surge, narrowing bid-ask spreads by small margins, even in volatile weeks. Market liquidity could also shift from paper-driven to regulated onshore platforms, contributing to tighter delivery windows and enhanced collateral discipline during harvest seasons or refinery outages. Farmers, traders, and logistics firms could see more predictable price signals tied to global benchmarks. Large multinational commodity majors may restructure hedging desks around this platform, aligning with Indian price discovery. Banks providing settlement and custody services stand to gain fees and cross-border rails. Asset managers and pension funds might diversify into onshore commodities, testing new liquidity corridors. Retail investors could finally access defined Indian contracts through familiar brokers, while exporters worry about price transmission and importers about tariffs and delivery risk. The platform's reach will extend from agribusiness to steel, petrochemicals, and fertilizers, reshaping their risk management playbooks. Geopolitics and currency dynamics frame the timing of such platforms. India seeks to deepen financial autonomy while aligning with BRICS and regional supply chains, potentially drawing investment away from opaque corridors. A softer dollar environment can boost commodity demand and price volatility, affecting import bills for India's energy and metal-intensive sectors. Global central banks face balancing acts between inflation and growth, while sanctions or export controls in major producers ripple through the logistics chain. The platform also interacts with global trade agreements, customs reforms, and digital identity standards, creating a layered backdrop that traders must monitor alongside seasonal cycles. Smart money is already placing bets on improved liquidity and standardized risk controls. Sovereign wealth funds and large pension schemes are evaluating exposure to Indian commodities via cleared products, comparing cost of carry against Hong Kong and Singapore references. Banks are pricing new cross-border rails, expecting modest fee growth and stronger resilience during volatility. Retail platforms are testing user-friendly dashboards that track price discovery in real time, inviting a broader audience. Some funds may bypass futures entirely and access physical inventory through trusted partners. The dynamic is shifting from pure direction bets to structured hedges aligned with real-world supply chains. Risks remain even with momentum. If the platform fails to deliver seamless cross-border settlements or suffers governance delays, liquidity could retreat, hurting confidence faster than it builds. Concentration of risk in a few large participants might amplify systemic shocks, while cyber threats and operational outages could trigger margin calls and forced closures, echoing lessons from past clearing failures. Overregulation can dampen innovation and push activity underground into opaque channels. Local reforms or currency shocks may destabilize price signals, confusing farmers and exporters making hedges. A sudden shift in global macro conditions could unravel anticipated spreads between onshore and offshore prices. For retail traders, staying disciplined matters more than chasing headlines. Start by evaluating your broker's access to Indian contracts on the new platform and confirm settlement terms, margins, and delivery mechanics. Use small positions to test liquidity during off-peak sessions before committing heavier sums. Build hedges with diversified instruments across geographies to avoid single market risk. Monitor price discovery versus legend of benchmarks and set alerts for abnormal volatility or settlement failures. Focuses on cost of carry, funding rates, and currency exposure as you rotate between futures, options, and physical storage. Seek independent research and avoid over-levered bets. Looking ahead, the Gift City platform could become a staple in the global commodity map, linking Indian farmers and manufacturers to a wider audience and potentially reducing price gaps. If adoption accelerates, expect tighter spreads, more transparent settlement, and better risk controls across cycles of harvest and refinery runs. Yet the outcome depends on execution, cyber resilience, and the ability to harmonize with existing exchanges. Traders should stay alert to regulatory updates, currency swings, and shifts in global demand. Analysts expect cross-border growth to expand gradually over the next year. If you found this valuable, subscribe to the Commodity Brief for weekly insights on alternative assets and commodities.